Good morning, everyone. Please turn on your videos. So, as promised, there will be no recits today. This is really just a recap of what we had taken up the past few weeks and in preparation for the midterms as well. Okay, so I believe our midterm schedule is on Monday, right? Okay, so let's start. Okay, so as mentioned previously, corporate governance, which is our subject, is basically hold on, huh? Hmm. Okay. So basically, corporate governance is that system of stewardship and control to guide organizations in fulfilling their long-term economic, moral, legal, and social obligations towards their stakeholders. So as you notice, class, the term that is used is not just stockholders, but rather the more general, the more inclusive term of stakeholders. So basically, corporate governance will apply not just the relationship between the directors and the corporation and the stockholder, but it also includes the relationship between the corporation, its employees, its vendors, its customers, and the community that the corporation operates in. Okay? So this system is intended to provide direction to the corporation, to provide feedback, and to ensure control such that in the performance of their functions, the board and senior management are held to high performance and ethical standards to ensure that they are accountable for their behavior, for their decisions, not just with respect to increasing shareholder value, but also to benefit all stakeholders and society. So that is the role of corporate governance. So it's not just a matter of how much can the corporation earn, but also how positively the corporation can impact society. Okay? Now, as mentioned before, corporate governance is important because without corporate governance, there is a conflict between board of directors taking shortcuts in order to ensure that the corporation earns profits. And in turn, when the corporation earns profits, that means more compensation, more bonuses for them and for senior management. Okay? But our law and our rules recognize that the impact of a corporation is so much more than the profits. Okay? Especially for large corporation, large conglomerates, that also has an effect on the public, that has an effect on society. Okay? So what is the purpose of corporate governance? First of all, we know it's protection of investors to make sure that investors are able to make decisions with all the necessary information to make sure that investors are not defrauded and to make sure that investors also are protected from any acts of the directors and senior management which could be detrimental to them. Second, to prevent abuse by controlling shareholders. So as we know, the controlling shareholders control the board. So in that manner, they also can control the operations of the corporation. Third is to ensure accountability of directors and management. So to make sure that they are held accountable for their decisions and to maintain confidence in capital markets. Nga naman, because if you've noticed, class, in the corporate governance, code of corporate governance, there are two types of corporations that are governed or has to comply with the code of corporate governance. First, you have your listed companies, so publicly listed companies or the PLCs, and then you have your public companies. So that includes those whose shares are registered under the SRC, as well as those corporations with assets of more than 50 million and having 200 or more stockholders, each holding 100 shares each. Okay? So that is the scope of corporate governance. And each, as you know, each of those corporations have public ownership, meaning they sell or they issue their securities to the public. That affects capital markets. Because if one corporation defrauds its investors, that will shake investor confidence in the capital markets. And if their confidence is broken, their trust in capital markets is broken, then that means that investors will not put their money in the capital markets. So what's the effect of that? That means fewer resources to grow the economy, fewer resources to grow the business. So you need to have corporate governance in order to maintain confidence that when you invest your funds in these publicly listed corporations, you can be assured that these funds will be used well by the corporation in accordance with that declared purpose. Okay, so for example, if the corporation will be issuing shares or bonds because they want to put up a new factory, so corporate governance is a way to ensure that that will be how the proceeds will be used. Okay? So that's why corporate governance is very important. Now, there in the last few years, there has been several challenges brought about by kaning mga inherent conflict no between the board and the public. So what were the challenges that were faced by these companies, and how did the SEC, through the revised corporation code, through the SRC, establish reforms to address this issue? So first is concentrated ownership structure. So as you know, it's more prevalent in Asia, not so much in the US or in Europe, that in Asia, the corporations are mostly held by family groups. Diba? If you've noticed, we'll say this corporation like the Ayala is owned by the Zobels. Then you have the SMs, which is owned by the Cs. So they control conglomerates, not just one type of corporation. They have malls, they have banks. So concentrated ownership structure, that can be prone to abuse. Okay? That can be prone to majority stockholders bulldozing the rights of the minority stockholders. So it's difficult to attract investors when a large group controls a public company. Then because of this concentrated ownership, most of the directors are nominees of that group of stockholders. So there is a lack of board independence. And of course, there is a potential for conflict of interest through related party transactions. So related party transactions, as you know, is when a corporation enters into contracts with its own board, with its own stockholders, or its subsidiaries, or affiliates or those entities which are under common control. So these are the challenges that were faced in the last few years, and these are the reforms that have been put in place through the SRC, the Revised Corporation Code, and the Code of Corporate Governance. So, as you know, the SRC has put in a lot of provisions for the protection of the rights of stockholders, stakeholders, and disclosure standards, and the requirement of an independent board. Then, in terms of shareholder engagement, so as you know, there are venues now available for the shareholder to air out their issues with the corporation. And of course, the regulators also has a role to play. And the primary regulator here in the Philippines is the Securities and Exchange Commission. And as to listed companies, you have a secondary regulator, which is the Philippine Stock Exchange. So the Philippine Stock Exchange class is what we call as an SRO, or self-regulatory organization that can regulate its members. So they are allowed, the PSE is allowed to impose rules and regulations. It's allowed to impose fines and penalties on its members. Okay, so you've seen this graph before. So the reason for the existence of corporate governance is there is this push and pull relationship between the shareholders and the board of directors. So as you know, the shareholders are the ones who own the corporation. They are the one with the power to approve fundamental acts, and they are the ones with the power to elect or remove members of the board of directors. In the same manner, the board of directors, on the other hand, will be the body that governs and controls the corporation. They have a fiduciary relationship with the stockholders who elected them, and their goal and purpose is to set the strategies. They have oversight of management, and they are accountable for the disclosures that is made to the stockholders. So stockholders has control in the sense that they elect and remove they have the power to elect and remove members of the board, and the board of directors has the power to disclose and report to the stockholders, as well as they have accountability for to the stockholders for their decisions regarding the corporation. Okay, now as you know about the doctrine of centralized management, we've discussed this already. The reason why there is this segregation between ownership and control and management of the corporation is that the board basically comprises of people who are knowledgeable, they have the know-how, they have the technical expertise to guide and to control and to manage the corporation. Okay, so the management of the corporation is centralized in that board. It cannot be given to the stockholders because the stockholders are too numerous and they may not have the expertise required to manage the corporation. So it's easier to give that authority to a small group of persons, which is your board of directors. So that is the reason, class, for this doctrine of centralized management, which tells us that the corporations are subject to the broad regulatory powers of the state, and it is the directors and officers who are tasked with addressing questions of internal policy and management. So it's the business of the corporation is conducted by the board of directors. So in the same manner, the case of Filipina Sport Services also tells us that corporate powers of all corporations shall be exercised, all business conducted, and all property of the corporation are controlled and held by the board of directors. So that is the doctrine of centralized management, which is the backbone of corporate governance. Okay? Now, what is the role of management here? So, kanina we were saying that it's the shareholders who own and they are the corporation and they are the ones with the power to elect and remove the board. On the other hand, the management are the ones who execute the decisions of the board of directors. So the board of directors class do not really run the day-to-day operations of the corporation. They set strategies, they set goals, and they set the performance standards for the corporation. But the people who actually executes and undertakes the day-to-day operations of the corporation is management. And management reports their performance to the board of directors, and the board of directors have the power to delegate authority to management as well as the power to oversee the actions, the decisions of management. Okay? So in essence, you have the three bodies here. You have the stockholders who are the owners, the directors who govern, direct, and supervises the corporation, and management who executes and operates the day-to-day business of the corporation. Okay? So that is the relationship of these three groups. Now, under the SEC memorandum circulars, as you know, there are two SEC memorandum circulars, right? The first one is on the publicly listed corporation, and the second one is on public corporations and those whose securities are registered with the Securities and Exchange Commission. So, for PLCs, this is the 2016 Memorandum Circular, there are several principles that each corporation must comply with. And each principles come with their own recommended set of actions. Now, as I mentioned to you before, under our corporate governance, it's not a one size fits all. So dili nga black and white that everyone is really required to comply regardless of the state of their operations, regardless of the state sa ilahang regardless of their requirements sa ilahang business. That's not the case. It's a principle of comply or explain. So if a corporation or an issuer cannot comply with the recommended action under the Code of Corporate Governance, they will need to explain why they are deviating. They will need to explain what mitigating measures have been taken in order to prevent the abuse or the lack of internal control because of the failure to comply with the recommendation under the Code of Corporate Governance. Okay? So, what are the principles class under the Code of Corporate Governance for PLCs? So, it's divided into 5 groups. So, you have board governance responsibilities, you have the disclosure and transparency requirement, you have internal control and risk assessment, then you have shareholder relations and stakeholder responsibility. Okay? So, on board governance and responsibilities, the first principle is that the board must lead effectively, they must promote long-term success, and act in the best interest of the shareholders and stockholders. So, basically, under this principle class, it requires that the board of the corporation must be competent. They have to be qualified and they must have diverse backgrounds in order to ensure that all aspects of a decision are considered. So dili pwede, for example, nga ang imuhang board of directors are all lawyers or all engineers. So a good board must be diverse. So naay engineers, naay lawyers, naay CPAs. Not just that, you must also be diverse in terms of how many man ang inyuhang male nga board of directors, how many are female. So diversity in the boards is very important. So not just qualifications, not just their competence, not just their training, but diversity as well. Okay? Then you have the director's roles, duties, and accountabilities must be clearly defined and understood. So, if you've already started in your for your report in the study of the Manual of Corporate Governance, so you will see there that each manual will list down. So a good corporate governance manual must list down the duties and responsibilities as well as the scope of authority of the board. So not only that, there should be a clear succession planning for the board. There should be a performance management system for the board in order to ensure that the board of directors are aligned in their accountabilities and they know what they have to deliver and they know what is the scope of their authority as the board of directors of the corporation. And then the third principle is that the board should be supported by board committees. So there are different board committees, so we will take them up later. But in general, the more usual committees are your audit committee. Basically, this is the committee which is responsible for reviewing the financial reports of the corporation. This is the committee which liaises with the external auditor, and they are the ones who approve or endorse the financial statements of the corporation to the board and the stockholders. Then you also have the risk committee. So sometimes class in smaller companies, isa lang ni siya ka committee, audit and risk. But in larger companies, you have a separate risk committee whose job is basically to assess internal and external risk that is faced by management and to determine the potential impact of this risk to the corporation. So, in your annual report to the stockholders that the corporations have to submit, the PLCs have to submit, you have to clearly discuss there the risk that the corporation is facing. So, whether it's an external like politics, issues regarding kaning mga wars. So those things that can affect the business. And then you also have internal risk. So what if you have mga manpower issues, things like that, or there's a case against the corporation? Those are things that are tackled and handled by the risk committee. And then you have the related party transactions committee. So this is the one that studies and endorses material related party transactions. And of course, you have normally they are also one committee lang. You have the governance, nomination, and remuneration committee. So this is the committee that sets the governance policies for the corporation. They are the ones who study the qualification of nominees to the board as well as senior management. And they are also the ones to set the remuneration for the senior management of the corporation. Okay? And the next principle is that directors must devote sufficient time, act with independence, and exercise objective judgment. So basically, this is a combination of the two principles of board commitment and independence. So for board commitment class, there is a requirement in publicly listed corporations that you can only be absent in board meetings for a certain number of time. So ang board meetings, the attendance of each director will be taken and it will be reported how many times a certain director was absent from the meeting. So there is an expectation that if you are elected as a board member, you have to do your job and attend the meetings. Okay? What else? There is also part of the board commitment is that you cannot sit in too many boards. Because if daghan ra ka gilingkuran nga board or daghan ra kag directorship, that would mean that you can devote less time to each corporation. Kay daghan naman ka og giatenan nga board meetings. So there is a limit as to how many seats or how many board membership that a director can have. And for publicly listed corporations, the recommendation is that for non-executive director, you should have maximum of 5 board directorships, meaning you can only sit in the board of 5 corporations. And of course, you have to notify your corporation before you accept another board seat. Okay? So there is that expectation that when you are elected, you have to devote your time and your commitment to the corporation. Important that the board should act with independence. So as you know, under the RCC, the requirement is 20% of the board must be independents. But if you notice in the Code of Corporate Governance, the recommendation is at least 1/3 with minimum of 3 independent members. And as previously mentioned also, independent directors can only serve for a maximum term of 9 years. So beyond 9 years, they cannot serve as independent directors anymore, but they can serve as a non-independent. So they can be a non-executive director, or if they are part of management already, then they can become executive directors of the corporation. Okay? Then one other aspect of independence class that is not required under the RCC or the SRC, but it is recommended by the Code of Corporate Governance, is that you have to separate, because this is the normal practice for non-listed corporation, that the president is also the chairman of the board. But the recommendation under the code is that the chairman should not be the same person as the president or the CEO. Nga naman, because ideally, class, the chairman should be non-executive director. So they should not be part of management. And as you know, the president or the CEO is an executive director, di ba? Because the president is part of management. So in order to ensure that the board is independent from management, the chairman of the board should not be the president. Okay? So these are some of the principles with respect to board independence. And then, of course, as part of their accountability, board should undergo regular performance evaluation. So how often? They should do it kanang internally once a year. So normally it's self-evaluation. They are required to evaluate themselves and each other annually. And then every 3 years, an independent facilitator will be the one to assess the performance of the board. And of course, there has to be a mechanism where the assessment will be communicated to the board of directors. So they have to know what the findings are. Okay? Then last for board governance responsibilities is that directors must uphold high ethical standards. So the corporation through the board of directors is required to adopt its code of business conduct and ethics, and the board is expected to be the persons who must implement, monitor, and ensure that this code of business conduct and ethics is followed through or implemented by the corporation. Okay? So that is in terms of board governance responsibility. So we're talking here about the qualifications, the duties, and responsibilities of the board. Okay, so that is the first group of principles under the Code of Corporate Governance. Then the second group of principles has to do with disclosure and transparency. So, as we previously discussed, um, full and fair disclosure is an essential part of the requirement under the Securities Regulation Code, 'di ba? In fact, the SRC is known as the Truth in Securities Law because a very basic foundation requirement in the SRC is that if your shares are registered with the Securities and Exchange Commission, you must regularly disclose uh, to the public and to your shareholders with regards to your operations. So if you remember our discussions previously, three instances ka mag-disclose, right? So the first one is an annual disclosure through your annual report. Second is your quarterly disclosure through your quarterly reports. And then you have your material events disclosure, which is your current report that is required to be made within 10 minutes from the time that a material transaction or material event takes place. Okay? So, what does the Code of Governance require with respect to disclosure and transparency? So, first of all, it is required that there should be a robust disclosure policies that is aligned with best practices and regulations. So it's not something that you will just leave up to chance. Nga, okay, we'll follow it this year and then next year, dili na punta mo follow. No, you have to have written policies as to what are required to be disclosed when you should make a disclosure. Then, second is to ensure independent and high quality external audit oversight. So, part of the requirements on disclosure and transparency is that the financial statements of the corporation should be audited. Okay? Then, not just the financial reports, but also non-financial reports are important. So currently, I think just this year, the SEC came out with the requirements for ESG reporting. And the requirements are pretty stringent because it applies not only to publicly listed corporations or to public corporations, but it applies even to private companies whose revenue reaches 15 billion per year. So even non-listed corporations or those that are not registered with the SEC, for the securities are not registered with the SEC, are required to file those reports starting in 2028. So that is the ESG reporting requirement. Okay? So ESG is your environmental, social, and your governance reporting. So that is part of your non-financial reporting because that is not financial statements. The report is not financial statements. So imong financial reporting will include your balance sheet, your income statement, your cash flow statement, your equity statement. Those are financial reports. But on top of that, the SEC is also very stringent about the requirements for non-financial information. Okay. Then you need to have effective communication channels for all stakeholders. So it is required that when a company lists in the stocks exchange or registers their shares in the SEC, they are required to have a good company website where they can post news, they can post mga press release, they can post information regarding the operations of the company. So it's not just through their filings with the PSE, but as well as kanilang mga day-to-day interactions with their stakeholders. So that's normally done through the company website. Okay? Then you have the requirement on internal control and risk management. So this is where the risk oversight committee comes in. So it is the risk oversight committee is the one, the board committee that is required to set up and implement an enterprise risk management framework to ensure that all risks are considered and they are reported properly. So here, class, normally in that ERM framework, the corporation is required to determine for each potential risk, they are required to determine how likely will the risk happen. So the probability of the risk happening, whether it's likely or remote, so they will assess that, and how much is the impact of that risk if it happens. So they have to have a matrix that is your enterprise risk management framework that is going to assess and to quantify the risk. So for example, if the risk is remote, and the effect is, let's say, 1 billion pesos, then you need to quantify what is the extent that we are going to report on this risk. Or when the risk is likely, but it's say the exposure is only 100,000 pesos, is that something that we need to report? So you need to have the framework, the risk management framework, in order to know which risk needs to be reported and which risk does not need to be reported. So it's important that you set up a PLC must set up an internal control and a risk management system. And it's the risk oversight board committee that monitors and implements this. And of course, you need to have shareholder relations. There is the requirement that you have to protect shareholder rights. You need to provide a facility or venue for shareholders to air out their concerns, and you must treat all shareholders fairly and equitably. And then, of course, not just stakeholders, but also not just stockholders, but also stakeholders. So this basically outlines the relationship between the corporation with the community, with its employees, with the vendors, in order to ensure that there is proper stakeholder accountability. Okay? So those are the principles, class, for Code of Corporate Governance for PLCs. Then you also have a different Code of Corporate Governance for public companies and registered issuers. But if you look at it, basically the principles are the same. So you need to have competent board, meaning qualifications, the diversity, clear roles and responsibilities so they know what are their duties, their authority, and their accountabilities, establishment of board committees, and of course, you need to have the commitment to enforce the commitment of the board of directors, board independence, assessment of board performance. So basically, it's just the same set of principles, minor lang ang deviations niya. Then on board ethics, disclosure policies, external auditor independence, then you have disclosure and transparency. How can stakeholders access relevant and material information? Internal control and risk management system, promotion of shareholder rights, and promotion of stakeholder rights, which includes employee participation, as well as the non-financial reporting requirement, which is on sustainability and social responsibility of the corporation. So basically, the code here is just a mirror with minor deviations lang from that of the PLC. So you are expected with your reports to be familiar with these principles. So what I would need you to do is compare this Code of Corporate Governance principles and recommendations with the manual of your chosen corporation. So the manual basically is the set of rules and policies that are set by your corporation. And then you also need to compare that with their annual corporate governance report. So you have the law or the rule, which is the Code of Corporate Governance. You have the manual, which is the internal policies of the corporation. And then you have your annual corporate governance report, which tells you how the corporation actually implemented their manual. So it's basically the report is the grade of the corporation as to whether or not they've complied with their manuals or if deviated. If they're deviated, then they need to explain the reason and the cause for the deviation. Okay? So we will take up more of the Code of Corporate Governance when we go to your reporting. Okay? Questions? Any questions? Okay. If there's none, let's proceed. 1 minute class, ha? Just. Okay. So now that we've taken up the principles under the Code of Corporate Governance, let's just do a recap of what we had previously discussed with respect to boards, fiduciary duties, accountability, and independence, as well as shareholder rights. Okay? So, as you know, as we said, it's the board who manages the affairs of the corporation. And how do they do this? By acting as a body. And as we discussed previously, the board, an individual member of the board by themselves has no authority. They are only authorized to act as a body through a meeting for that particular decision or corporate action that they want to implement or approve. Okay? As you know, two types of meeting for the board of directors, the requirement for notice, and the place of holding the meeting, which can be anywhere inside or outside of the Philippines. So this is more lenient compared to shareholders meeting, which can only be in the principal office of the corporation. Okay? So more lenient in order to give the board more chances to attend the meeting. Okay? Then, of course, you have the quorum requirement. As we discussed in the board of directors meeting, it is important that there should be a quorum. And how is a quorum determined? It is based on majority of the number of directors or trustees stated in the articles of incorporation. So it's not the actual number of board of directors, but the number that is stated in the articles. So, for example, if your article says 10 members of the board, but in reality, you only have 8 members because 2 seats are vacant, pila man ang imuhang quorum. So the basis for the quorum should be the 10 and not the 8. Okay? So kung 10, that would mean 50% plus 1 to get a quorum. You should have 6 board members present to have a valid quorum. So 6 of the 8 must be present in order to have a valid quorum. Okay? And Take note on the approval requirement. So the decision reached by at least a majority of the directors or trustees in a meeting where there is a quorum is a valid corporate act. So here of the, for example, 8 of the directors attended the meeting, so you have a valid quorum because you only need 6 for quorum, right? So if 8 attended, how much approval do you need? 50% plus 1. Majority of those who attended, so you need 5 votes to approve a corporate act. So the requirement is majority of those in attendance in a meeting where there is a quorum. Do you get that? Okay? So 8 attended, you need to have 5 approve the board corporate action. Do you get that? Okay? Now, what if only 5 attended and 5 approve? Is that a valid meeting? It's not, because you don't have quorum. Quorum, as mentioned, should be 6 because you base it on the number of directors stated in your articles of incorporation. Is that clear, class? Okay, so that is how the board acts. They act as a body. They do not have powers or authority in their individual capacities. Okay. The requirement, as mentioned earlier, 20% under the RCC, but under the Code of Governance, it's actually 1/3. So who is an independent director? It's a person who is independent of management and free from any business or other relationship with the corporation or other persons that are connected with the corporation. Can independent directors hold shares in the corporation? Yes, but maximum of 2% of the subscribed capital. If mo exceed sila og 2%, that means that the director can no longer qualify as independent director. Okay? Now, also, I think I've mentioned this to you guys. Recently, just in January 2026, the Supreme Court, the Securities and Exchange Commission, came out with Memorandum Circular Number 7, Series of 2026. So this reiterated the rule that the 9 years maximum is now absolute and cannot be extended. So the moment that an independent director has served a term of 9 years, he becomes perpetually barred from re-election as independent director. But he can still be elected as non-independent director. Okay? In this regulation, the SEC said that this requirement is an exception to the rule of comply or explain in the Code of Corporate Governance, because here there's no ground to explain. It should always be comply. Okay? No more basis for the corporation to extend more than 9 years and just explain. They're not allowed to do that anymore. They should only comply with respect to the term limits of independent directors. Okay, then on the board committees, so we mentioned ganina that the corporate governance requires that the publicly listed as well as the public corporations should designate and create their respective board of committees. So not just with the executive committee, but for other purposes as well, like your audit and risk committee, your governance committee, your nominations committee, your related party transactions committee. So what is important, class, is that these committees must comply with Section 34 of the RCC because they are acting as a board of director, meaning they have the authority of the board. They can make decisions that the board can make. So the requirement under Section 34 is that the committee should be created in the bylaws. Because as you know, if they are not provided for in the bylaws, they cannot approve any corporate action. Their power and their authority is merely recommendatory if wala sila in the bylaw. So the contemplation in the Code of Corporate Governance is those committees that you have in the publicly listed companies, they should all be created under the bylaws. So they have the power to act as a board of directors with respect to their specific purposes like the audit and risk. So they have the power to approve and endorse and resolve issues with respect to the audit. Then you have the related party transactions committee. So they have the power to question and to approve related party transactions. Then you have your governance. They are the ones to set the qualifications and the requirements for board members as well as senior management. So each, in order to have the authority to act as a mini board, must be created in the bylaws or must be specified in the bylaws of the publicly listed corporation. And take note that even if they are created in the bylaws, there are some approvals that they cannot make. So for example, approval of any action where shareholders' approval is also required, filling in vacancies to the board, amendment or repeal of bylaws or adoption of new bylaws, amendment or repeal of any resolution of the board which by express term is not amendable or repealable, distribution of cash dividends to shareholders. On these five matters, the committees cannot or has no authority to act. This must all be acted upon by the full board. Are we clear? Okay, so that is this section 34 applies not just to executive committees but other special committees created by the publicly listed corporation. Okay, then as mentioned ganina, what are the board committees? The normal ones, you have the usual ones, you have the executive committee, audit and risk, so this can be combined, related party transactions, then you have the governance, nominations, and remuneration. Again, small companies, combined sa ni sila. Okay? So these are the usual board committees. And why do we have committees? So that the board can focus on their specific issues where they have expertise in. So for example, you don't expect nga naa kay engineer sa imuhang audit and risk committee. So audit and risk committee will normally be composed of mga CPAs and mga lawyers because they look at financial statements and they also are the ones to monitor and identify the risk of the corporation. So you expect that the members of the board committees should also be experts in the particular committees that they are members of. Okay, so this allows the board members to focus on their particular areas of expertise in addition to their authority and their obligation as part of the board of directors as a whole. Okay, then you have the power of the board of directors. So as you know, under the RCC, you have three powers, which is your exercise corporate power, they conduct all the business, they control and hold corporate property. So jurisprudence tells us that directors have threefold duty. You have the duty of obedience, which is basically that they have to direct the affairs of the corporation in accordance with the purpose for which it was organized. So this is largely related to the requirement of competence and qualification and the duties and responsibilities of the board. They have to be aligned with the purpose of the corporation. Okay? Then the duty of diligence, which is that they should not willfully or knowingly vote for or assent to patently unlawful acts of the corporation, and the duty of loyalty, which is that they should not acquire any personal or pecuniary interest in conflict with their duty as directors or trustees. And if you notice, class, these are also reflected, particularly kaning duty of diligence and duty of loyalty. These are also reflected in the Code of Corporate Governance explicitly. Okay? So, you have the business judgment rule. As you know, the decisions of the board of director is binding on the corporation, it's binding on the shareholders. So courts and the shareholders do not have the power to replace the decision or the judgment of the board of directors with their own decisions or judgment. Furthermore, as we know that as long as they act in good faith in making their decision, the board of directors will not be responsible for any losses or damages that happens to the corporation because of their decision. Okay? So they are also insulated from personal liability for these actions or decisions that they've made for the corporation. That is on the business judgment rule. Okay. Then Section 30 tells us when the directors or trustees will become liable. So if you recall class ang jurisprudence, so it will tell us that directors can be held liable with their personal property as well as the decisions of the board for damages caused by their decisions in the board if they willfully and knowingly vote for or assent to patently unlawful acts of the corporation. They are guilty of gross negligence or bad faith in directing the affairs of the corporation. They are guilty of conflict of interest. And on top of that, you have the assent or they tolerate the issuance of watered stock. And lastly, if they themselves expressly took on that liability. So this liability, these sources of liability for directors is on top of the liability under piercing of corporate veil. So kaning lima nga sources of liability for board of directors class, this is based on law and separate from the liabilities that may be imputed to the directors under piercing of corporate veil. Okay, so just to outline the duty of care and diligence, so you have the requirement that in determining the or in running the affairs of the corporation, the directors must act in good faith. They must not be guilty of bad faith or gross negligence. So here, several cases, the Supreme Court said that bad faith is a question of fact and a matter of evidence. So it cannot just be an allegation. There must be a showing of a clear and convincing proof of such unlawful act, negligence, or bad faith, such that it is not just a question of bad judgment or negligence, but really there is that imputation of a dishonest purpose, moral obliquity, or a conscious wrongdoing such that the act of the director partakes the nature of fraud. In the same manner, gross negligence will also have to be an act that is characterized by even the slightest care, acting or omitting to act in a situation where there is that duty to act. It should not be inadvertently, but it should be willful and intentional with a conscious, not necessarily a requirement that you want to harm somebody or you want to cause damage like in bad faith, no? But there should be a willful and intentional conscious indifference to consequences. So you don't want to harm, but you know the consequence and you still acted that way or failed to act to prevent the consequence. So that is gross negligence. So any violation of this is a violation of the duty of care or diligence of the board of directors. Then you have the duty of loyalty. And as you know, there's a lot of this requirement under the RCC. So here you have, in case that the director is disloyal to the corporation, meaning they acquire a business opportunity which should belong to the corporation, the consequence is that they will be accountable to the corporation for any profit that they derive from that particular transaction, unless the stockholders, by at least two-thirds vote of the outstanding capital stock, will ratify the transaction. Okay? Um, so, how do you know that there is a violation of the doctrine of corporate opportunity, meaning the director was guilty of conflict of interest? So, first is that the corporation is financially able to exploit the opportunity. So, it has sufficient funds to undertake the business. The opportunity is aligned with the purpose of the corporation. The corporation has an interest or an expectancy in the opportunity because it is part of the regular business of the corporation. And by taking the opportunity for his own, the director is placed in an inimical position to that of his duties in the corporation. So if A, B, C, and D are present, there is a violation of the doctrine of corporate opportunity, and the director will be held liable under Section 33 of the Corporation Code. Are we clear? Okay. Then, of course, you know about self-dealing directors. What is the rule on self-dealing directors? The contract where there is a self-dealing director is voidable, meaning it can be annulled or it can be ratified. Okay? So, annul meaning it will be voided, no force and effect, or it can be ratified, meaning it can be executed or consummated. So, how do you make sure that the contract with a self-dealing director is not voidable? The law tells us that you have to comply with these three requirements. So the presence of the director was not necessary in order to constitute a quorum during the meeting where the contract was approved. Second, the vote of the director was not necessary for the approval of such contract. So when you do this, you remember the rule on quorum for board of directors meeting, meaning majority of the number of directors stated in the articles, and the voting must be majority of the directors present in a meeting where there is quorum. If in both instances for quorum and for approval, the presence of the director concerned is not required and the contract is fair and reasonable, the contract will be valid and not voidable anymore. Okay? Now, if any of the condition is missing, then the contract is voidable. But as you know, it can still be ratified by the vote of the stockholders representing at least two-thirds of the outstanding capital stock or two-thirds of the members. Except class if the corporation is vested with public interest, in which case material contracts, because this is part of related party transactions naman. So material contracts should be approved not just by the majority of the board, but by two-thirds of the entire membership of the board, and at least a majority of the independent directors must vote to approve. Okay? So that is the rule on self-dealing directors. Then you have interlocking directors. So in case of interlocking directors class, the contract is not voided on the ground alone that you have interlocking directors. So contract is valid even if you have interlocking directors. Except if the interest of the director in one corporation that was a party to the contract is substantial, and the interest in the other corporation that was a party to the contract is nominal, in which case the law says you have to comply with the requirements for self-dealing director as far as the corporation where he has nominal interest. How do you know whether it's substantial or nominal? The law tells us anything in excess of 20% is substantial, 20% or less is nominal. So only when there is a disparity, one corporation substantial interest and the other corporation nominal lang iyang interest, you have to comply with the requirements for self-dealing. But if it's substantial, no need to comply. The contract is valid. If it's nominal, again, the contract is valid and not voidable. Are we clear? Okay? Then, you have the duty of obedience. So basically, this is the duty of the board of directors to direct the affairs of the corporation in accordance for the purpose for which it was organized. And as stated in the corporate governance, the Code of Corporate Governance, it is the duty of the board to oversee the development of and approve the company's business objectives and strategy and to monitor their implementation to sustain the company's long-term viability and growth. So the actions, the policies, the strategies that should be set by the directors should be aligned with the purpose of the corporation. Okay? Then you also have the liabilities and prohibitions under the SRC for board of directors. So we took this up last meeting, so this should still be fresh. We'll just go through it. You have prohibition on insider trading. So as mentioned, being an insider is not punishable. Okay? What is punishable? Sorry, being an insider is not punishable. Trading as an insider is also, as a general rule, not punishable. So you're a director, you can trade with the securities of the issuer. But what makes it unlawful under Section 27? When you are an insider and you trade the securities while in possession of material information that is not generally available to the public. So being an insider, not punishable. Trading as an insider, again, not punishable. But trading while in possession of material, non-public information, that is what is penalized under Section 27. Okay? So here, how do you know that the information is material? So as previously mentioned, it's material when it affects a decision of whether or not to buy security and how much should you buy or sell a security. That is what is determined by materiality. So if that information can affect a decision of whether or not I should buy or sell a security or how much I should buy and sell, that is material information. How do you know that it's non-public or the information is not yet generally available to the public? The law tells us that it is non-public if the information already existed but has not yet been disclosed. Or it has been disclosed but no sufficient time has lapsed for the corporation or for the public to absorb the information or to analyze the information. So it is still considered as non-public information. Okay? Now, as mentioned, there's no specific timeline as to when the public can absorb the information. So there's no specific rule under the law as to what is considered a sufficient time for the public to absorb and to analyze the information. But the PSE has issued some rules, okay? So here, you have the PSE blackout rule where directors or insider cannot trade during this blackout period. So the minimum requirement class, I stand corrected, is not 72 hours but 2 full trading days after the information is disclosed. So that is the validity of the blackout rule. When information is already present but not yet disclosed, you cannot. 2 full trading days after the information is disclosed, you cannot transact. Okay? But the PSE gives some leeway. The corporation itself can set its own blackout rule. And the normal number of days for corporation or number of hours for corporations in their own internal rules is ranging between minimum of 2 full trading days up to 72 hours. Okay, but the minimum required by the PSE is 2 full trading days. So that's a total of 48 hours. Okay? Then you have prohibitions on short swing transactions and other speculative transactions. So as you know, what is prohibited here is a combination of purchase and sale or sale and purchase It's a transaction done by a director or a controlling shareholder that is done within a period of less than 6 months. So if it's purchase within 6 month period, not a violation. Sale and sale within 6 months period, not a violation. Purchase in January, sale in August, not a violation. Or sale in January, purchase in August, not a violation because it's more than the 6 month period. But purchase in January, you sell it in May, or nag-sell ka in May and then you purchase again, sorry, you purchase in January and you sell it in May, that is a violation. So it's a combination of purchase and sale or sale and purchase within a period of 6 months. It's short swing transaction, and directors are not allowed to do this as part of good corporate governance because this partakes a nature of a speculative transaction. Okay, so meaning nag-trading ka, you're making a business out of the trading of the security, and you're not allowed to do this because even if wala pa'y material information, directors are expected to know everything about the corporation. So it's not, they have an undue advantage if they engage in the trading of their own issuer. Okay? Then finally, as we said, directors are also not allowed to engage in short sales. So unsa man ang short sale? It is when you're selling security that you do not own, or if you own the security, the agreement is you will not deliver it until a few days after the transaction. So that is a short sale. As we said, short sale is generally allowed for the public although it's regulated, 'di ba? But for directors and controlling stockholders, it's not allowed at all. Are we clear? Okay? Then, as we said, under the business judgment rule, if the stockholders do not agree with the decision of the board, they are bound by that decision. They cannot compel the corporation to reverse the direction. But they have the power to remove the board member. Okay? So how do you remove a board member? You must have a meeting that is called for the specific purpose of removing that board member. Who will make the call? It's the corporate secretary upon order of the president or upon written demand of the stockholders owning at least majority of the outstanding capital stock. Now, if the secretary fails or refuses to call the meeting, the stockholder or member making the demand, so meaning katong na ay majority outstanding capital stock, may themselves directly call for a meeting. They don't need to go to the SEC and ask for an order allowing them to call a meeting. They may call the meeting directly. Okay? So during the meeting, in order to approve the removal, you need to have the vote of the stockholders representing at least 2/3 of the outstanding capital stock or 2/3 of the members. And the removal may be with or without cause, except that removal without cause may not be used to deprive minority stockholders of their right of representation. So if you're going to remove a director who is a nominee of the minority stockholders, the removal should be with cause. Dili pwede without cause. Okay? Then, SEC may also by themselves motu proprio or upon verified complaint, remove a director from the board. Okay, so that's it on the fiduciary duties of directors when it comes to managing the affairs of the corporation. So now let's go to the other side, which is shareholders' rights and investors' protection. Now, shareholders' rights class under corporate governance rule is technically divided into two. Fundamental rights of stockholders, which are basically applicable to all stockholders, and you have rights of minority stockholders, which technically still applicable to all stockholders, but in practice, it's the minority stockholders, or these rules are established for purposes of protection of minority stockholders. So it's applicable to all, but the purpose really is to protect minority stockholders. So let's start with fundamental rights of stockholders. So you have the right to attend and vote in stockholders meeting. So as you know, you have two types of meeting for stockholders as well. You have your regular meeting, which is done annually, special meeting, which is done as may be necessary. So the importance of the regular meeting is that this is the meeting where the stockholders will elect the members of the board of directors. And take note on the requirement for a valid stockholders meeting. Now, if the requisite of calling for the requisites for a valid stockholders meeting is not met, then what you have is an improperly held stockholders meeting. And that means that the actions and the approvals of the stockholders in that meeting is invalid. They cannot be valid corporate actions. Okay? Take note, however, that when there is a discrepancy on the call or the notice or the venue, okay, the law tells us that as long as all stockholders are present in person or by proxy in that meeting and no one objected to the validity of the meeting, then that meeting will still be valid. Okay? So the rules on improperly called meeting will only apply to these three requirements. It's not applicable to quorum requirements. It's not applicable to voting requirements. Is that clear? Okay? So kanirang three ang pwede ma-waive. But in order to have a valid waiver, all stockholders must be present during the meeting, whether in person or by proxy, and none of them must have objected to the improper calling of the meeting. Okay. Then, as we said, for stockholders, they can attend the meeting in person, by proxy. They can also do it through remote communication or in absentia, provided that it is authorized in the bylaws or it is authorized by majority of the board of directors. Exception ani class is that in corporations with vested with public interest, even if walay provision in the bylaws, even if walay approval by majority of the board, attendance or voting by remote communication or in absentia is allowed. Okay? So stockholders are given a leeway in attending the meetings of stockholders, whether they can attend in person, they can attend by proxy, they can attend remotely or in absentia. Then how do the stockholders vote? So as previously mentioned, for stockholders, their vote is determined by the number of shares that they own. Diba? So if one stockholder owns 10 shares, then that means that the stockholder has 10 votes. Diba? Or one stockholder owns 100 shares, then that stockholder will have 100 votes. So one stockholder, one share, one vote. You are not allowed under SEC rules to have one share more than one vote. So you cannot designate that this class of common shares will have 2 votes per share. You're not allowed to do that. It's always fixed at one share, one vote. Okay? Now, how is voting done? So as mentioned, voting can be in person. They can also be done by proxy or through a representative, or they can also be done through a voting trust, which is still through a representative. But what is the difference between a proxy and a voting trust? In proxy class, as you know, there is no transfer of legal ownership of the shares. The shareholder executing the proxy remains to be the legal owner of the shares, such that it's that shareholder who has the right or is qualified to be elected as a board member. The proxy holder, if he does not own shares in his own right, can attend and vote, but he cannot be elected as a member of the board of directors because as a proxy holder, he does not qualify as a legal owner of the share. Do you get that? Okay? A voting trust, on the other hand, is different because in a voting trust, the trustee actually acquires legal ownership of the shares, such that the law allows that if you have a voting trust, you are allowed to cancel the stock certificate in the name of the trustor, and a new stock certificate will be issued in the name of the trustee. So as far as the stock and transfer book of the corporation is concerned, it's the trustee who is the legal owner of the shares. So the trustee or the holder of the voting trust may, by virtue of that voting trust, be elected or is qualified to be elected as a member of the board because the voting trust agreement transfers legal ownership. Do you get that? Okay, whereas a proxy only temporarily assigns the right to vote. Okay, so those are the two modes of voting through representative. And then, of course, stockholders have economic rights. They have the right to receive dividends, and dividends can be in cash, they can be in property, or they can be in stock. Take note though that if it's cash or property dividends, board approval is enough. But if it's stock dividends, it should be, aside from board approval, there should also be approval by at least 2/3 of the outstanding capital stock. And take note that if there is a delinquent stockholder, while he is entitled to cash dividends, that should first be applied to the unpaid balance of his subscription, while stock dividends will be withheld until the subscription is fully paid. Okay? Take note that a corporation is required to declare dividends if their retained earnings is already in excess of 100% of their paid up capital, because the SEC can actually penalize them in this situation if mo exceed na ilang retained earnings of 100% of their paid-in capital. So how do you rectify this? So you just need to transfer from unrestricted to restricted retained earnings para dili ma-penalize ang corporation. So how do you transfer to restricted? If you have definite corporate expansion projects, so the amount of the project. If you are prohibited under any loan agreement, so you restrict your retained earnings also. If there is a requirement to reserve funds for probable contingencies. So in these three instances, class, you transfer from unrestricted to restricted retained earnings, and in that case, you will not, if wala na ang imong unrestricted ni abot of 100% of your paid up capital stock, then wala na kay exposure to penalty from the SEC. Okay? Then you have the right to information. Ganina, we said that part of corporate governance is disclosure and transparency. And as we've previously mentioned, the right to information of stockholders is very comprehensive. So during stockholders meeting, they are required to be appraised. So the management and the board of directors needs to make a report to the stockholder of everything that happened to the corporation within that year. They are also given the right to inspect corporate records, to inspect the stock and transfer book, and they have the right to be provided with copies of the financial statements of the corporation. So here is the full and fair disclosure requirement under the SRC. So before a corporation can even register their securities under Section 8 of the SRC, they are required to create a prospectus which contains all the information regarding the issuer so that the investing public can make a decision of whether or not they want to purchase the shares of that particular issuer. So the prospectus is a document. If you want, you can see copies of mga prospectus also in PSE Edge. So you can check on that. You will see that it contains comprehensive information regarding the issuer. So you cannot register securities and sell them to the public if you do not create and issue your prospectus. Okay. Then as mentioned earlier, under the SRC, so katong mga publicly listed and public corporations, they are required to submit an annual report, interim, which is quarterly report, and of course, they are also required to make current reports. So current reports are those reports on significant or material transactions undertaken by the issuer. And as I said earlier, current reports must be made within 10 minutes from the happening of the material event. Okay? Then you have preemptive right of stockholders, which is basically the right of the stockholders to maintain their proportionate shareholding in the corporation. So when the corporation uh, articles is silent, preemptive right exists. Okay? So it's a right that does not need to be expressly granted in the articles. It will exist. But if you want to prohibit this right or to prevent preemptive right, you have to expressly provide in the articles of incorporation. Okay? Then you have prohibitions on fraudulent and manipulative practices. So this is also provided in the SRC for the protection of shareholders. So these acts are prohibited. So first is engaging in securities transactions to give the impression of activity or price movement when in reality there is no such movement. So that is painting the tape. Then you have making your transactions at the end of the day in order to influence the closing price of the security, that is marking the close. Engaging in transactions where you have buy and sell, but in reality, there is no change in beneficial ownership because the parties, the buyer and the seller, are just colluding with each other. You have improperly matched orders. Then you have engaging in activity at increasingly higher price and then selling it at higher prices. That is your hype and dump. And then you have engaging in transactions where there is no change in actual ownership, but this time ikaw lang, wala kay kakulyud. That is what we call as wash sale. Taking advantage of shortage in securities by controlling the demand side, knowing nga walay nagbaligya, nagsigi kag make og demand, so you're squeezing the float. The purpose here is to increase the price of the security. Then disseminating false or misleading information and other types of manipulative practices. These are prohibited under the SRC, and the purpose for the prohibition is in order to protect investors or stockholders of the corporation. Okay? Then you have minority shareholder protection. As I said earlier, this is applicable to all stockholders. All stockholders has this right, but the purpose of this right is in order to protect minority stockholders. So first of all, you have cumulative voting. So this is the only instance class where voting is not one share, one vote, but rather the voting is number of shares multiplied by the number of the seats that you need to elect in the board. So if you have 10 board members and you have 500 shares, then your vote is 500 times 10 or 5,000 votes. Okay? And you are allowed to give as many votes as there are directors to be elected, so 500 each per director. Cumulate the said shares and give to one candidate. So give all the 5,000 to one director candidate, or distribute them to on the same principles to as many candidates as they deem fit. So 2,500 for director A, 2,500 for director B. It's okay. Pwede sad nga dili equal. 2,000 votes for Director A, 3,000 for Director B, provided that the number of votes should not exceed the number of shares owned by the stockholder multiplied by the whole number of directors to be elected. So this cumulative voting is a mode to allow minority stockholders to have representation in the board. So rather than distributing their votes, they can cumulate and give it to one person who will be their nominee or representative in the board of directors. Okay? Then you have derivative suit. As discussed in the case of Agor Realty, a derivative suit class is not one that is found in law, but rather it is founded on equity. So when can a stockholder file a derivative suit? The derivative suit happens when a wrong or damage is done to the corporation, but the board of directors refuses to take action. Okay? Ordinarily, when a wrong or damage is done to the corporation, it's the job, the obligation of the board of directors, and it's within their authority to file a case on behalf of the corporation, di ba? That's the power to sue under their own name. Now, if the board of directors fails to do this, and because of this failure by the board, the minority shareholders are adversely affected, then the minority shareholders can themselves take on the authority to sue on behalf of the corporation. And that is what we call as a derivative suit. Ngano derivative man siya? Because the power to sue by the shareholders is derived from the wrong done to the corporation. Meaning the real party in interest is not the stockholders themselves, but rather the corporation. But because the directors refuses to take action, then the stockholders themselves may take action by filing a derivative suit. Okay? So you distinguish this class, for example, from an individual or a class suit by the stockholder. So an individual or a class suit, the damage is done to the stockholder. So for example, the corporation refused to allow the shareholder to exercise their preemptive right. So the stockholder affected can file an individual case against the corporation because he's the one that has been damaged or adversely affected by the decision. Or if daghan sila wala gipa-exercise of a preemptive right, then they as a group can file a class suit against the corporation. Again, the damage, the persons in interest are the stockholders themselves. But in a derivative suit, for example, the other party to the contract breaches the contract with the corporation, the authority to file the case should be with the board of directors. Diba? Okay, it's the corporation man nga na damage or na disadvantage. But if the directors fail to act, the stockholders can take on that right and be the one to file a suit on behalf of the corporation. That is your derivative suit. Okay? Then, of course, you have your appraisal right. So, appraisal right is a right, technically, minority shareholder ka because there is an action put forth before the stockholders and the action is carried out, meaning approved siya by the stockholders. So that means they need to have majority or 2/3 to approve that particular action, di ba? But you are a dissenting stockholder, meaning you disapprove the action. So you can now exercise your appraisal right. Okay? So it's a right that is given sa katong stockholder nga wala nakadaog. But it's only limited to 4 instances. In case of an amendment in the AOI that has the effect of changing or restricting the right of any stockholder or class of shares, or in case of an extension or shortening of corporate term. Then you have in sale, lease, or exchange of all or substantially all the corporate assets, in case of merger or consolidation, in case of investment of corporate funds for purpose other than the primary purpose of the corporation. So in this 5 instances class, the stockholder who dissented, meaning he did not approve the corporate act, may exercise appraisal right. Now, if the corporate action was not carried out because wala naka-reach sa voting requirement, whether it's majority or 2/3, wala na carried out, kaya wala na approve, can you exercise your appraisal right? Pwede ba? Wala man na carried out ang corporate action, wala siya na-approve, but you dissented. You are one of the majority who dissented. You cannot exercise appraisal right. You can only exercise appraisal right if the action was approved or carried out by the corporation. That's why this is a right to protect minority stockholder, meaning ang majority ning approve but ikaw di ka ganahan, you can exercise appraisal right. Okay? Then you have the tender offer rule, which basically, a minute. Okay. So the tender offer rule found in the SRC class is basically it is a right granted to minority stockholders to exit the corporation under the same terms and conditions as majority stockholders. So when is tender offer required? So under the rules of the SRC, tender offer is required if there is a person who intends to acquire equity securities of a public company or a company that is an associate or related company of such public company and the acquisition reaches the threshold under the rules. So if these elements are present, the purchaser is required to make a tender offer. So what is a tender offer? It is a publicly announced intention by a person acting alone or together with other persons to acquire outstanding securities of a public company or that of an associate or related company of such public company. So in a tender offer, the purchaser will make an announcement that I intend to buy the common shares of XYZ Corporation. My purchase price is 20 pesos per share. Whoever wants to sell their shares to me, let me know and I will buy. So that is what a tender offer is. Okay? So when is tender offer not required? If the acquisition is at 15% in one or more transaction within a period of 12 months. So kung 15% lang ang i-acquire, you don't meet the threshold. Or even if it's 35%, but you are buying through the exchange trading system or through the market, tender offer is also not required. Because if you're buying from the market, anyone who wants to sell can sell to you. So not required for tender offer. But if the acquisition is 35% or more over a period of 12 months, then you are required to do tender offer. So here, if it's done over a period of 12 months, that is what we call as a creeping transaction. And the tender offer must be done to all holders of securities within such period. And the offer is limited only to that percentage that you want to buy or you want to acquire. Okay? If oversubscribed, meaning mas daghan ang ning offer than what you actually initially wanted to buy, you don't need to buy everything. You just prorate. Okay? Then another instance where tender offer is required is you're acquiring 35% of the outstanding voting shares one time, or this is what we call as a block sale. So what's the difference between a block sale and a creeping transaction? If it's a block sale, you are required to take up all the shares, all the voting shares that's being offered to you under the tender offer. But voting shares lang ang imong kailangan i-acquire. Now, if the acquisition would result in over 50% ownership of the total outstanding security, meaning even if 5% lang imong paliton, but you already own 48%. So your acquisition of 5% will now give you over 50% ownership of the shares. In this case, you are required to do a tender offer, and this time you are required to make an offer to all shareholders, whether voting or non-voting, and you are required to accept all securities tendered. So, creeping transaction, voting shares lang. And if sobra, you prorate. Block transaction, again, voting shares lang, but you have to take up all the offered voting shares. But if it's an acquisition that will result in more than 50% ownership, you have to take up all the shares offered, whether it's voting or non-voting. Okay? So to recap, this tender offer rule allows the minority stockholders to exit the corporation under the same terms as the majority stockholders. Because if dili ka mag-tender offer, wala ka kabalo nga ikaw minority stockholder ka, wala ka kabalo gibaligya na dai sa majority stockholder ang iyahang share. So you're left holding the bag with the new controlling stockholder, 'di ba? So that can put you at a disadvantage because the new controlling stockholder can now acquire your shares and price you at a lesser price than the majority. Kay minority na lang man ka, wala man kay as much right and control over the corporation as the majority. But with the tender offer, they have to make an announcement that they want to acquire majority, 35%. Anyone who wants to sell, including ang mga minority stockholders, can sell their shares at the same rate as that offered to the majority stockholders. So that is the purpose of the tender offer rule. Are we clear? Okay. Then, just very fast, there is a new rule on beneficial ownership. Technically, class, kaning rule on beneficial ownership is really to highlight or to identify who is the actual owner or the beneficial owner of a company, particularly in situations where you have corporate layering. So sa corporate layering, a corporation is the stockholder of another corporation, di ba? So di ka kabukin sa man yun ang tinuod nga person who owns this corporation. So under the rules on beneficial ownership disclosure, you go to the pinaka natural person who owns the share. So beneficial owner can only be natural persons. Dili pwede juridical persons. So these are the persons who controls and owns the majority shares of the corporation, or they maintain ultimate effective control, whether it's through contract or whether through it's their position with the corporation. They control the corporation. So here, you need to make a disclosure with the SEC who the ultimate beneficiary or the beneficial owner of the securities are. So, recently, sa una class, kaning beneficial ownership, it's a page that is attached to the general information sheet. So when you file your general information sheet, you attach this page, this declaration when you file with the SEC. But currently, just this year, the SEC changed its rules in order to protect the privacy, data privacy of the beneficial owners. Dili na siya kailangan i-attach to the general information sheet, but rather, there is now a separate, basically a separate gateway through which the beneficial ownership report is submitted. So lahi na siya nga submission from the GIS. So this is now done online, dili na physical ang disclosure on beneficial ownerships. Then you have the rules on related party transaction. So as you know, when is related party transaction considered as material? When it amounts to 10% or higher of the company's total asset. Only when the related party transaction is material do you need to make a report to the SEC. Okay? And who are related parties? So you have publicly listed companies, directors, officers, substantial shareholders, spouse, relative within the fourth civil degree of consanguinity or affinity, legitimate or common law. You also have persons who have joint control or significant influence over the publicly listed corporation. It also includes parents, subsidiary, affiliates, joint ventures, or other entity that is controlled or jointly controlled or influenced by the person who is a related party. So take note that the related party rules and disclosure requirement only applies to publicly listed companies. Okay? So if there is a material related party transaction, 10% of the assets, the corporation is required to report that to the Securities and Exchange Commission. And then what is the role of the board? So the board is the one to set the policy on the related party transactions policy. They approve the transactions. So as you remember, class, if it's kanang self-dealing directors and vested with public interest, you need 2/3 approval of the board, diba? Then they ensure that systems and there's controls that's being followed. And there is a policy on whistleblower. So if systems or the policy is being violated, there must be a way to report that to the board. So this is the role of the board of directors as far as related party transactions are concerned. Whereas for senior management, they are the ones who implement the policies that the board has set. So they implement the controls and they ensure compliance with these policies set by the board. Okay? So that's it. That's your assignment na, which you already. So that's it for our discussion. Any questions? Okay, so everything that we took up today will be covered in your midterm exam, included in the coverage for your midterm exam. Okay, so that would be on Monday. So if there are no more questions, then that's it. I'll see you guys on Monday. Then after the midterms, we will now start with the reporting. So the first meeting after midterms, we will start with the reporting. So I will be calling groups at random during that meeting. So everyone, please prepare. So as mentioned, you will be given between 10 to 15 minutes to make your report. Okay? Yes, all essay. Okay? So any other questions? No more questions? Okay, that's it then. So good luck on your midterms. See you guys. Bye-bye.
Thank you, attorney.
Thank you,
Thank you,
attorney.
attorney.
Thank you,
Thank you,
attorney.
attorney.